What if I told you the biggest bond trends of 2025 are hidden in plain sight? Let's dive into the biggest trends no one's talking about. 2025 is shaping up to be a fascinating year for bond investors, with trends that could take many by surprise. These aren't just background noise to stock market headlines. These bond moves could help shape your portfolio's future. Here's what's happening. In 2025, those paying attention to current trends could position themselves similarly well for the next decade. First up, increasing popularity of U.S. Treasury bills, notes, and bonds. With interest rates bouncing around like a Mexican jumping bean, U.S. Treasury yields have been seeing increased demand from investors who are looking to lock in some higher returns with the full faith and credit of the United States government. Despite the Federal Reserve being on a glide path to lowering interest rates, the 10-year Treasury continues to bounce above and below 4%, and the 30-year around 4.5%. With the wild roller coaster ride of interest rates of the last 20 years, a lot of investors are locking in these higher yields while also getting the protection against possible interest rate declines by the non-callable nature of treasuries. One of my favorites is the 20-year Treasury, which, because it has lower institutional demand, often yields higher than both the 10-year and the 30-year, but still provides 20 years of call protection. I would certainly expect some future volatility over concerns that the U.S. debt is spiraling out of control, and the rating agencies continue to look at U.S. government debt for possible downgrades. However, these dips could be the buying opportunity you're waiting for. Whether you're an all treasuries, all the time investor, or you're looking to put a little certainty into your stock-heavy portfolio, I expect treasuries to be on the radar of a wide variety of investors, so you'll want to keep an eye on those in 2025. Number 2, the return of corporate bonds. Corporate bonds are seeing some love again, with investors seeking stable companies that offer higher returns than treasuries. This is great for long-term steady income, but requires careful selection, especially in industries facing disruption. The challenge here is, if you're expecting a possible recession in the U.S. economy, you're probably looking to take some profits now in those equity positions and park that money where there's a little bit of certainty. While bonds can provide stability and certainty, corporates can be vulnerable to some of the same volatility as stocks of the same name. In 2025, I think we'll see people moving to the safety of individual bonds in sectors that are a little more recession-proof. Remember this is about individual bonds, not bond funds and not bond ETFs. We discussed the details of why in the video on your screen now. Next up, number 3, the rebirth of U.S. municipal bonds. Municipal bonds are seeing a resurgence, especially as states are investing heavily in infrastructure. These bonds are backed by a variety of projects, and in 2025, the federal government is further incentivizing them. The benefits? Tax-exempt income and the chance to support your local community. We could see a real surge in demand for tax-exempt bonds because the Trump tax cuts are about to expire, and with a divided government, a lot of investors are worried they're going to be paying higher taxes. Munis could be the best hedge against those uncertainties in 2025, so keep an eye on the municipal bond market. For those of you in states that don't tax interest, here's a graphic with a few of the states that have some of the better yields on their municipal bonds. One of my favorites are Texas school bonds, which are guaranteed by the Permanent School Fund, or the PSF. They only back the schools with the best financials, so that's a high-quality underlying rating. And the PSF guarantee has a AAA rating, and has since I started in the business back in 1991, and well before that. Number 3, the rise of digital bond marketplaces. So here's something interesting. Digital marketplaces are transforming bond buying. We will likely see new platforms in 2025 make it easier than ever for retail investors to access corporate bonds, municipal bonds, and even international offerings. For everyone who felt left out of the bond market in the past, these platforms open new doors. For example, when I was researching this video last week, Fidelity's electronic bond offering platform had over 287,000 different individual bond offerings. That included more than 6,000 brokered CDs, over 700 U.S. Treasury offerings, more than 1,400 U.S. government agency offerings, and 68,000 plus corporate bond offerings, and last but not least, more than 208,000 municipal bond offerings. All completely searchable and completely executable on the platform. That's a lot of opportunities to find a bond that meet your risk tolerances and your financial objectives. It wouldn't surprise me in the competition for customer accounts if we start to see some of these platforms begin to incorporate artificial intelligence into the customer side of their platform. Each year we see even greater usage of algorithms and AI on the dealer side of the bond market, and I don't expect 2025 to be any different. One place you may experience this is on the bid side. When you're trying to sell a bond on one of these platforms, you may see a bid come back very quickly because it's not always a trader looking at it anymore, but instead it's an algorithm putting a bid on your bond. If you're enjoying this journey through my 2025 bond market crystal ball, go ahead and hit that like button. And while you're at it, please subscribe. It's like getting a VIP pass to the world of bonds. No waiting in line and no cover charge. Your future self will thank you. Which brings me to my professional tip from my 30 plus years of bond trading. One thing I've been doing in 2024 and will continue to do in 2025 is use these spikes in interest rates to restructure call protection. When rates spike, consider selling bonds with shorter calls and replacing them with bonds that have longer call protection. This strategy can help lock in higher yields for a longer period of time and protect you from having a lump of cash to invest when interest rates are lower because your bonds got called. Because the market perceives that your bond with the shorter call is less likely to be called, you could see closer parity with similar bonds with longer calls. In my career, I've seen many interest rate cycles. My go-to advice, stay adaptable. Flexibility in bond investing is really valuable. Bonds aren't just safe, they're strategic. Stay alert to what's happening in the market and diversify within bonds to cover your bases. Number 4, interest in high-yield bonds. The high-yield market is always controversial, but in 2025, with shorter interest rates expected to go lower with Federal Reserve rate cuts, a surprising number of institutional and individual investors will want to take on a bit more risk for the potential of greater returns. Defaults can happen, but with the right analysis, some high-yield bonds may be a smart move this year. I think we'll see more investors reaching for yield in the shorter end of their portfolios as risks of default can be a bit lower here. They'll be turned off by lower yields, which they haven't seen in a couple of years, and they'll take on a bit more risk to try to relive the glory days of the past few years. Number 5, focus on shorter duration bonds. Given current economic uncertainty, shorter duration bonds will become a preferred choice. These bonds mature sooner, giving you quicker access to your capital, an appealing option in times of economic flux. This means you'll have the cash available to scoop up bargains, whether in stocks or bonds, should the U.S. economy go through a bit of a rough patch. Number 6, foreign bonds are seeing more attention. A lot of folks are suggesting 2025 will see a rise in investors looking beyond U.S. borders for bonds. Many are exploring international bonds, particularly in emerging markets where returns can be enticing because of higher interest. I traded foreign bonds for a few years, and I'll tell you, they're not for the faint of heart. There are an awful lot of moving parts like global interest rates, global exchange rates, inflation, and the list goes on and on. And those problems are not just in the country that you're buying, they're here as well. They're global. I haven't seen a market where it makes sense for U.S. investors to take on a huge amount of additional volatility of foreign bonds for some incredible return. For my own investing dollar, heck, I think you have a lot more certainty in an S&P index fund, along with more upside, than you do in buying bonds overseas. If you think I've got this completely wrong, please hit me up in the comments below. I'd love to get your take on what opportunities you're seeing. Number 7, growing popularity of callable bonds. We talked about callable bonds earlier, but there's an opportunity here as well. As folks start to reach for more yield, because rates are coming down, callable bonds may attract more of those folks. Callable bonds can be risky, but with yields fluctuating, investors can find those bonds attractive. Issuers may call or repurchase these bonds when it suits them, but they often come with a higher initial yield. In 2025, I think we'll see continued interest by retail investors in callable bonds being purchased at a discount. The previous decade saw a huge issuance of bonds with lower coupons. Today, these bonds are trading at a discount to their face value. Should they get called sometime in the near future, some of the folks who've been buying them will be getting double-digit returns for owning something that has very little downside risk. Number 8, rising demand for social objective investing. In 2025, we'll see further demand for social objective investing, where people choose investments based on both returns and the potential to create positive societal impact. This movement is about supporting causes important to investors, often at the cost of possibly higher returns elsewhere. First up, you've got green bonds. These bonds help fund environmentally sustainable projects, including renewable energy and green buildings. Organizations like Fannie Mae are leading the charge, having issued over $100 billion in green bonds to promote energy efficiency and environmentally friendly housing projects. This type of bond is increasingly popular for investors, prioritizing sustainability while earning stable returns from fixed income products. Number 2, veteran-related investments. We've got veteran bonds, and we also have the stock symbol VETZ. Socially responsible investment funds like VETZ dedicated to the veteran causes allow investors to support military veterans through their stock and bond selections. Funds like these direct capital toward veteran-owned businesses or initiatives focused on veteran welfare, making a direct social impact while providing investors with a way to align their portfolios with their values. Number 3, housing bonds, which finance affordable and accessible housing solutions. For example, Fannie Mae also offers multifamily social bonds targeting affordable housing development and financing housing in moderate income areas. The goal is to make housing more accessible while providing a way for investors to directly support the affordable housing movement. While these investments allow individuals to back meaningful projects, it's essential to understand the trade-off. Social objective investments might not yield the same high returns as more traditional options. This is a deliberate choice. Investors are prioritizing social impact over maximum profit, supporting initiatives that reflect their values and potentially accepting lower financial gains as part of the equation. If this helped make 2025 investing trends clearer, check out our video on how to invest when the Fed is lowering rates. It's packed with tips on reading market cues to maximize your bond strategy. Always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer.